I mean, she weighs into the inflation debate just as people are perhaps seeing that kind of conversation, if you will, die down a little bit, and it's been all reignited again.
Well, we're seeing it across the board, aren't we, really? You know, commodity prices still at the highs there. Probably haven't seen the full effect of all those price-moving commodities coming through into the real inflation numbers as companies somewhat absorbed it, but now we're hearing more and more stories about companies saying we've actually got to pass it on, which means it's going to end up in the household CPI budget. So for us, with those strong growth numbers, and you've got more spending around the corner, it looks to us like inflation is still likely to be higher here. So the tapering has got to be on the table. I think we've already got a little hint about that.
Hayden, we know that, though, don't we? That's it. It's a question of when it happens, and perhaps we're trying to preempt any tapered tantrum as we saw a few years ago.
I think you're right. Well, I think we got a little bit of a hint of that when they said, right, we're walking away from the corporate purchases on the bond side. So they've essentially already started, which lines you up for Jackson Hole there. So you've got enough time from here to then to step back and say, okay, we've got better growth numbers. Sure, the unemployment was weak, but we know the jobs openings are at record levels and they haven't filled them. So it's just inevitable until those jobs start coming through. So for us, that points to higher yields.
The thing is, Hayden, I mean, we had weaker than expected jobs numbers, but wages are higher and lots of money is sloshing around. I mean, how will this play out in the next few months?
Well, we think those jobs numbers come through. You get to Jackson Hole, they'll then announce some sort of tapering. Then the question is, the market, is it fourth quarter or first quarter of next year? And I think that's where the debate's going to switch to. But as usual, markets will run ahead and they'll already start pricing it in straight away. So as we come into Jackson Hole, expect the temperature to go up. Really, that's going to be the key turning point in this QE. They should have enough evidence by then.
You know, yields at 1.5657, pretty much stalled at 1.7. If you take a look at where yields could be, I mean, what would it take for yields to break out meaningfully?
Well, I think if we strung together a couple of strong employment numbers, a bit of a catch-up, maybe there's been some issues with capturing the data in these tougher environments. You string a couple of those together, we could well and truly be back up above 2%. I think that's how you've got to be thinking here. Tapering, higher yields, maybe not a temper tantrum, because this one wouldn't catch people by surprise. The only thing we're worried about, though, is that's going to lead to some higher volatility and how equity markets are going to handle that when bond markets aren't quiet anymore. Because bond markets are giving equity markets a real boost here, being quiet and just trending sideways. And that's the key question, comes back onto credit markets for us then.
Well, absolutely. And so you've got to ask yourself, where's the juice here? And are treasuries, for one thing, a one-way bet?
Well, they've been tough. So I think here you still want to be positioned short. We're already seeing clients coming to us already saying we're thinking about floating rate product instead of fixed rate product. And so that shift is probably just in its early stages. I think we'll see a lot more money moving in that direction. The concern is on the credit market side, because everything is expensive. We know investment grade credit spreads all-time tights, high yield spreads, same sort of area. Asia's looking a little bit better. We've still got a valuation gap here relative to the US and Europe. So maybe that's some happy hunting there. And then the other thing is duration is quite short in Asia, particularly in high yield markets. So we're only around 2 years worth of duration. So maybe that's the place to be putting your dollars to work today.